Welcome to Investor's Guide. Thank you so much for tuning in. I'm Faye D'Souza. Like we do every week, we're going to help you this week find a good investment option, find and design a portfolio that suits you best, and fundamentally get rich over the long term. If you have a question for us, our email ID is at the bottom of your screen. So pick up a pen and paper, write down the advice you get on the show. We're going to start by telling you why you should not mix insurance with investment and why equity is the best way to go over the long term. In our product review, we look at the Tata Infrastructure Fund, and we'll help investors decide which asset class suits them best in the short term. Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra has been our advisor for the last 8 years almost. Thank you so much for joining us, Dhirendra. Well, Sunil has written in, Dhirendra, he wants to build a corpus of 20 lakh rupees in the next 5 years and 5 crore rupees in the next 22 years. He sent us his financial details. Now, he has the SUKANYA SAMRIDDHI YOJANA for his daughter, about 1.2 lakh rupees a year. And we'll remember that the government revised the rate of interest on this along with all of the other small savings. He's also using the FD and the National Savings Certificate. He says he wants to start now investing in ELSS, but then he discontinued what he invested last year, and he'll begin investing right now. So he sent us a list of the funds, and we'll get to that list in a little while, Dhirendra. He had some other very interesting questions he wanted to ask us, but I first want to ask you this. For someone with such direct and ambitious targets, if we run a back-of-the-envelope calculation, if he makes about 12% on his investment, and that's 30,000 a month, he'll be close to 18 lakhs over the next, say, 5 years, which is his first target. And over the next 22 years, he'll be close to 4 crore rupees, not 5 crore rupees. But this is at 12% interest compounded. It's not something he can expect from the National Savings Certificate or from fixed deposits, can he?
No, not really. He will have to get his principles right. One important thing is that fixed income for the long term is not a great way to build wealth. It's, look at the Sukanya Samriddhi Yojana. It is a safe investment. It is useful for people who do not have access to market-linked investment, who do not have the understanding, or they are unsure. So for people in remote areas, people who are not financially educated and literate, who can't comprehend the market-linked or the volatility of market-linked investment, it is a safe investment. It will give you predictable return. It will not make you rich. And somebody who is exploring mutual fund, this is just the kind of investment where you should be doing your SIP with a fairly understandable goal. Investment for 15-18 years, a recurring deposit, so to say, or a SIP, and so that money should ideally be into an equity fund. And only when you get closer to the goal, only when your daughter grows up and you need that money for the wedding or the education, is that you should convert it into, or get closer or have higher allocation, start moving to fixed income. But long-term investment into fixed income is a bad way to plan your financials.
Long-term investments into fixed income is a bad way to plan your financials. Dhirendra, I'm going to give you a list of the funds that he would like to invest in. UTI MNC, Mirae Asset Emerging Blue Chip, Franklin India Smaller Companies, DSP BlackRock Microcap, and iProve Value Discovery. Would you recommend he continues and goes ahead with these investments, or are one of our pre-designed portfolios a better idea at this point?
He will be better off with one of our design portfolio, maybe the aggressive growth plan portfolio or the growth portfolio. He seems to be guided by what has worked well in recent past. So I would say that he should take a middle of the road approach. He should be into he should build his portfolio with multi caps where he does not need to intervene, micromanage. And it will be a low maintenance way of building his portfolio, where he doesn't have to intervene.
Well, he has an interesting question for you, Dhirendra. He wants to invest only in the direct plan and choose the growth option. And he tells us that he wants to know, since he has a demat account with HDFC Securities, if he can use that to pick the direct option, or should he go to the AMC's website individually? Obviously, using HDFC Securities will not give him the direct option, because then the demat account is the intermediary in this case. He's going to have to go to the AMC's website. Would you recommend he does that?
He has to really clearly see that what is he deriving out of the intermediary. If he is investing in the direct plan, he has to go to the funds directly to make investment in the direct plan. if he's going to, if he's investing through HDFC Security, even online or any other broker online, then he will not be able to invest in the direct plan. He will be investing in the regular plan. Otherwise, there is no incentive for the intermediary to enable or facilitate his investment. So to invest in the direct plan, which is beneficial, and as he is doing his homework himself, he is making the choice and making investment himself, he'll be better off doing the direct plan, as the return over a long period of time will be better. Will be, on an annual basis, he'll be saving at least 75 basis points to 1%, 3/4 of a percentage to 1% more return on an annual basis compared to a regular plan. The other thing is that should he be investing in the growth plan? Yes, absolutely. He should not be investing in the dividend plan simply because it's simple. These are all long-term goals, and it is meant for long-term accumulation. He'll be getting a part of his money back by investing in the dividend plan, which will lead to smaller, which will present him the problem. Either he'll consume the dividend, or he will be posed with a new, just taking his money out and investing in again.
Dhirendra, he also wants to know if he can pick a fund and expect it to last for 22 years. He wants to know what your prediction or your forecast is. Now, here's the thing. Someone with a 22-year-old goal who's wondering, if I buy a fund today for the next 22 years, will it stay valid and viable for 22 years? Dhirendra?
Some of the mainstream funds will exist for the next 22 years, hopefully. And if they don't, they will actually change colors. But I would say, I would assume that, if it is not a if it is not a thematic fund, if it is not a sectoral fund, if it is not an exotic fund, then it will last. His money is not going to get derailed, or his money is not going to get lost, because we have seen that all the changes in the fund in the last 22 years or 20 years and more, they have changed colors. They have merged with other funds. They have changed their structure. Many of the closed-end, most funds started as closed-end funds. They have become open-end funds. But every investor's money, they have changed their name. What started as Master Gain became UTI Equity. So there has been change in complexion of the fund, the strategy, but the funds have continued.
So, and also remember, if you're making an investment for the next 22 years based on advice you've heard on this show, we're going to be here to help you understand whether you should continue with those funds, and if there's any reason why you should change, you'll hear it right here on the show. Quick recap of what we learned from answering this particular question. Use the growth option whenever you're investing in equity mutual funds, especially for the long term. It helps your money compound as opposed to taking money out with a dividend option. Secondly, use the direct plan, which is eliminating the intermediary or the advisor and going directly to the AMC. Use it if you're confident that you don't need the advice. And of course, remain disciplined and invest in equity for the long term. There is a quick question. 34-year-old Sanjay has written in. He says he has a monthly income of 85,000 rupees and he recently took a 50 lakh rupee joint home loan with his mother. He pays 50,000 rupees towards that home loan every month. He has a medical cover from his employer, 2 to 3 lakh rupees in a fixed deposit, and he has about 11 years left on his home loan tenure. He wants to now invest in long-term and short-term investments, and he's willing to put aside 10 to 15,000 rupees every month in mutual funds. What would you recommend for him as a mutual fund investment, Dhirendra?
He should just divide the amount of money depending on the amount he needs in the short run. And how will he define his short run? If his short run is going to be 5 years, still 5 years and more, maybe 6 years, some such frame or a negotiable goal which he can extend to that period, achieve it with a stable growth portfolio. And the money which he is unlikely to need, it is just primarily meant for financial security, and maybe in 10 years, he still has a long time to clear his home loan EMIs when he can start saving more. All that money should find its way into our growth plans and a growth portfolio or the aggressive growth portfolio.
All right, so our growth plan is on your screen right now. If you need anything else, you can get back in touch with us. We're going to be right here week after week to help you out. Welcome back. You're watching Investor's Guide in ET now. Thank you for staying with us. Dhirendra Kumar is with us as well. It's time for our product review, and this week we're looking at the Tata Infrastructure Fund. Avan is going to take a look at this particular fund and also the other funds in its peer circle to see if any of the infrastructure funds have performed at all. Avan.
Thanks, Faye. This week we take a look at a thematic fund, the Tata Infrastructure Fund. Now, infrastructure funds have not been particularly performing well in the market. But how does the Tata Infrastructure Fund stack up when compared to the rest of its peers? While the fund's long-term performance has been average since it was launched in the year 2004, Let's take a closer look at its performance over the last 5 years. The red line is the fund and the blue line is the benchmark. You'll see that the fund has underperformed its benchmark and its category since the year 2010 in both the bull and the bear phases of the market. The fund may have given marginally better returns than its benchmark in the year 2014, but slipped in the performance chart the following year. In fact, you'll also see that the fund has seen a lot of exits in the recent times, with its assets under management reducing by nearly a half to just about 614 crore rupees. Most of the peers in the category have also seen their assets shrink in the recent times. Infrastructure funds, being thematic funds, are also at a higher risk when compared to the other funds in the market. Is it time then for you to exit funds that invest in specific sectors and move towards a diversified fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Dhirendra, Tata Infrastructure lost money since launch, lost money over the last 1 year. If we look at the peer group, like Avan was telling us, it's disappointing all around. While you've always told us to stay away from thematic funds, infrastructure funds particularly have been a disappointing lot. Is it time for anybody who's holding an infrastructure fund to just walk away?
Yes, for a very different reason. There is a great possibility that infrastructure funds will make a comeback. Many of these infrastructure funds turned very big. You know, if you look at this fund, this was about 2,500 crore fund in 2008. Now it is 600 crore and about the same net asset value, which means 3/4 of the money has already flowed out of this fund, which means investors have walked out of infrastructure funds anyway. This fund is among the oldest infrastructure funds. It was among the first few infrastructure funds floated in India. It had a great run for the first 5-6 years. And all infrastructure funds, including this one, have struggled in the last 7-8 years. And it is actually a great lesson for investors not to get distracted to a sectoral or a thematic fund.
All right, see, this is the big lesson for investors when we look at this fund, and those returns are on your screen again. What Dhirendra is telling us is simply this: when infrastructure funds were announced or when they were launched, it was when infrastructure was doing well, and a lot of these funds were launched, a lot of people invested in them. And then a couple of years ago, when the new government took over, there was some sort of buzz that infrastructure would make a comeback, and we saw more people invest in these funds, but they really haven't shown us those kind of returns. So these are funds that get launched during a buzz period and you invest your money, but all sectors tend to be cyclical, and then you wind up on a depressed cycle on the other end of the cycle, and you're not sure what to do with these funds. Dhirendra says it's time to exit. Dhirendra, what's your rating then for the Tata Infrastructure Fund for Investors Guide?
I would slot all infrastructure funds at, the best of infrastructure fund. You have one or two which has been able to duck the trend. I would still slot them for the constraint that they operate in is a 3-star fund, and this I would slot it a lower below its risk-adjusted scale among infrastructure fund at 2-star.
All right, 2 stars for the Tata Infrastructure Fund or Investors Guide, 3 stars for all infrastructure funds. It really makes more sense to avoid them altogether. What I will do is put up on your screen our multi-cap funds. Remember, these are funds that invest all across the market. There's no restriction on the fund manager at all. You're better off in these funds. These are the funds that we recommend for the year if you want to make those investments. Dhirendra, one very quick question before I let you go. Senior citizen Uma Srihari has written in, retired railway employee who's on a pension right now as well as income from house rent. She says she pays tax on her savings, and she's invested in the ICICI Prudential Direct, the Quantum Tax Saving Fund and the Birla Sun Life Tax Plan. She also invested in the iPro Value Discovery Fund. She wants to now invest 5 lakh rupees in mutual funds for the long term. Should she use HDFC Mid-Cap Opportunities, BNP Paribas, she hasn't told us which fund, Franklin India Smaller Companies, SBI Magnum Balanced, what strategy should she adopt? These are aggressive funds for someone who's retired, so she's obviously someone with a decent appetite, given that her regular income is looked after, which is what she's telling us. How would you like her to invest her money?
I would like her to invest her money without assuming all the risk and spreading it over so many investments, so many funds. I would like her to restrict her investment to just 3 or 4, and that will serve the purpose well. And the formula will be very simple. She should invest in a tax saving fund, one tax saving fund every year, and that to a maximum of 1.5 lakh rupees or less, to the extent needed that will reduce her, that is needed to save her from paying taxes. So it can be a maximum of 1.5 lakh rupees under ATC or less, depending on the scale of income. Rest of the money should be in multi-cap funds. She should not get distracted by the mid-cap funds and other things. Having two such multi-cap fund and one tax-saving fund, and she should be very focused on simplifying her investment portfolio. Make sure that she has the nominee's name properly in each investment, and not change it unnecessarily. Don't resist your temptation to add these more investment, and having these three funds from three different fund managers will give her adequate diversification of style and exposure to all segments of the market.
All right, very, very simple advice. First on your screen, multi-cap funds that we recommend for the year. Pick any two of these funds and start investing for the long term. Next on your screen, conservative tax savers. Pick one of these two funds. So you have two multi-cap funds, one conservative tax saver, and you're done. No fuss about it. Start an SIP and start investing your money in these funds. Dhirendra is saying use the tax saver fund only to the extent that you need to save tax, not more than that, and the rest of the money can go into the multi-cap funds. If you have any more questions, you can get back in touch with us. Dhirendra, thank you so much for joining us on the show and answering all of those questions. It's a pleasure as always to chat with you. Email ID is at the bottom of your screen. If you have questions for Dhirendra, you know how to get in touch. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We've got Vishal Kapoor to answer your questions on asset allocation this week. Vishal, thank you so much for joining us on our show. Our first question comes in from Udayan, who is a software professional making about 7 lakh rupees a year. He sent us a list of his mutual funds, Vishal. He has the Frontline Equity, the Franklin India High Growth Companies, iProve Value Discovery and Reliance Small Cap Funds. He also has the Axis Long Term Equity, which he's using for his tax saving, and he's put a lump sum of 5,000 rupees in the iProve Exports and Other Services regular plan. He wants to know if his portfolio is on track. They seem like fairly well chosen funds. I'm not particularly happy with the thematic fund, but what's your advice, Vishal?
Mr. Nandi, firstly, I would like to congratulate you for a good start. You've got a good savings rate, you've got a fairly good diversified portfolio, a good selection of products, and I think therefore you're well on your way. So that's very well done. Second, I want to tell you that the IRR, the negative IRR you have right now is very natural in market times like this. So don't get disheartened. You've done a good thing in getting started with an SIP, you have a good savings rate. So it's important to keep the faith and look at the medium to long term rather than get disheartened with the current returns that your portfolio is generating. That's the nature of the volatility in markets, which is very much part and parcel of every investment that you've made. So stick through it. Now, what else could you do and how could you approach the portfolio better? I think it's important to first understand the basics of risk profiling and therefore how much risk you really should have. So if you've not done that exercise, please try and get that done through a professional so that you know what level of risk you are comfortable with. Whether minus 21% is what scares you, or is it even more that you can take, and then we should be able to construct a portfolio that's more attuned to the risk you can take. The second is, what I notice is that you don't have any fixed income exposure at all in your portfolio today. So that may be one way to balance out some of the risks. So that's something that we should consider as well. Having said that, I think what you've done is absolutely on track. So keep the faith and maybe review your portfolio, not very frequently. Once in every 6 months would be a good time, but maybe once a year is also adequate. If we sometimes get too close, then we can also make mistakes by reacting more often than we need to.
26-year-old Kapil has written in, Vishal, he wants to invest 30,000 rupees in mutual funds over the long term and he expects a 14% return. He also wants to accumulate 5 lakh rupees over the short term. He sent us a list of funds he's considering: the Axis Long Term Equity, Birla Sun Life Tax Relief, Birla Sun Life Gen Next, Birla Sun Life Top 100. He wants to know if he's on the right track. Too many funds from the same fund house for my comfort, but 14% is a tough target. Vishal, is that achievable?
Mr. Babbar, firstly, I think from the information you've shared, the objective of a short-term investment and the 14% returns may be a bit sort of unaligned. So it may be difficult for us to recommend something that you should expect a 14% return for in a 1-year period. Now, the specific funds that you have are in themselves good, so there's no necessity to really relocate them right now. But for the objective of the 1 lakh saving that you want to make in a short period of time, now the short period I'm assuming is maybe 6 months or up to a year, it would be probably better for us to look at a fixed income solution for that, but that may not give us the 14% return. If you were to look at something more modest, then to accumulate that sort of money, you will have to step up the savings that you're doing. So the 30,000 itself may not get you there. You may have to step it up to maybe about 40,000-50,000 rupees or so. So one way to do this is, increase your savings a bit more and take a bit more of a conservative view in the investment that we are making, because it is for the short term. The current funds may be volatile given the way the markets have reacted, and you don't want to miss the target that you are putting for yourself. So you could introduce a bit more of debt, and short-term debt funds might be a good way to go to meet the specific objective that you laid out for us.
What I'm going to do is I'm going to put up the list of debt funds that we recommend on this show on your screen right now, and you can use that list when you're investing in debt funds like Vishal instructed you to. Vishal, we only have time for one last question. Amardeep has written in on behalf of his 46-year-old mother. He tells us his mother would like to invest 10,000 rupees per month in mutual funds. She wants to have 70 lakh rupees in 15 months for her brother's children's education. Now, the objective doesn't add up at all. It's impossible to hit that objective. But if she wants to know what funds she would like to invest in, Vishal, what advice would you give her?
Mr. Kumar, I think the objective that you've set for us is very steep. I must confess that. For the objective that you've set, I think the savings that your mother will have to bring may be far higher. So to achieve the corpus of 70 lakhs, in 15 months, which is not a lot of time for us to generate investments to a very aggressive portfolio, you may want to look at a more modest fixed income exposure. That may not give you the type of returns that you've stated over here, which means that therefore the amount of savings would need to move up to almost 5 to 6 lakh rupees a month to meet the objective. So what I request is that we can go back and reconcile the objective to see that your mother is able to actually meet the need of 70 lakh rupees in 15 months for your brother's children's education by hopefully bringing a bit more investment or capital into that portfolio.
All right, that's a wrap on Investor's Guide this week. Vishal, thank you so much for spending time with us. Remember, if you have a question for Vishal or Dhirendra or any of our other experts, feel free to get in touch. Our email ID is at the bottom of your screen. You'll find a copy of the show on our Facebook page, and you can reach me personally on Twitter. Thank you so much for watching.